So the next video that I'm going to do is the inventory purchase budget. So I've got Brin Inc. and the name of this schedule is Inventory Purchase Budget. And this is going to be as at March 31st. So I'll just say March 31st. So what I like to do is when I'm dealing with balance sheet items, I just say the date that the end of the month is for, or the quarter. Okay, so I'm going to have, even though I might not need December, I'll put it there, but my reporting period is January, February, and March, and we'll put our quarter total, and then maybe we might need April. I'm not too sure if we need April at all, but we'll just include it. Okay, so the way that inventory works is if we start off with our budgeted cost of goods sold, and then we add our desired ending inventory, then those two together, so the total would be what we need. And then if I subtract out my beginning inventory, then that will give us what we need to purchase. So it's a little bit backwards because you've learned through your inventory accounts that we have beginning inventory, add purchases, that's what's available, and then subtract out your cost of goods sold, and that gives you your ending inventory. So when you look through it in a T account, it flows a little bit differently, but when we put it on a schedule, we kind of like to put it like this just so we can see what we need, and then that'll tell us what we need to purchase. Okay, so I'm trying to find the information here. So it tells me that in Part D, the company's gross margin is 40% of sales. So I know that sales minus cost of goods sold equals gross margin. So the cost of goods sold has to be 60% of our sales because the gross margin is 40%. So if I go to sales and then I multiply that by the 60%, that gives me my cost. So it makes sense that we are paying less than what we're selling it for because we like to make money. So I'll just show you how I took that again before I lock my formula down. So take your sales and multiply that by your cost of goods sold. So remember, sales minus cost of goods sold equals gross margin. They told me the gross margin was 40%. So now I'm just going to put $1 in front of here. And I'll scooch this over. And you can scroll the formula all the way over. And then this quarter ended should be the subtotal of January, February, and March. Okay, so now we're going to add in the ending inventory. So this one is a little bit more complicated. So they have to tell me what I want the ending inventory to be. So not in E, but in F it tells us at the end of the month, inventories to be on hand equal to 25% of the following month's sales stated at cost. Okay, so these are our sales stated at cost. And so if I get this sequence right, it's telling me we're going to do 25% of the following month's sales stated at cost. So I'm going to take the following month and times that by 25%. Then I'm going to take the following month and times that by 25%. Then I'm going to take the following month and times that by 25%. And then March, just remember I put a quarter in there, so the following month is April, and then I'm going to multiply that by 25%. So I'm going to subtotal these. And now what's a little bit tricky is inventory at the beginning of the quarter is the inventory on January 1st. So you can't subtotal these because inventory is just a snapshot. But, oops, I didn't mean to do that. But what we're going to do is I'm going to take the inventory from the beginning of the quarter, and that's January. So I'm going to put 90,000 there. And now I'm just going to add my January, February, March period. So when I add these together, this is what I need. So just add them together. And we can just scroll it over. Okay. So now we're going to deduct beginning inventory. So just remember, last month's inventory is this month's beginning inventory. So December is January's beginning inventory. The inventory on January 31st is the beginning inventory on February 1st. So it's just continuing on. The inventory on February 28th is the beginning inventory on March 1st. And then the same thing with the quarter. The ending inventory for the quarter is March 31st, so I'm going to put that there. And I'm not sure if I need anything for April, so I'll just leave that as it is for now. We might need to come back to it when we're preparing our balance sheet. So we'll see. So now I'm just going to subtotal this. So 330 minus 60,000 equals 270. 405 minus 90,000 is 315. 210 minus 45,000 is 165. And 870 minus 45 is 825. Oh, look what I did here. I'm silly. You guys probably noticed my mistake when I was working on it. It says desired ending inventory. So ending inventory is the inventory on March 31st. And this one says beginning inventory. So beginning inventory is 60,000. I'm not going to bother reshooting the video. So hopefully you can make those two adjustments if you listen to the video until the end. Okay, so I do want this to look pretty. So what we normally do is the first line of your schedule, we put dollar signs on it, and then our last line, we put dollar signs on it. And I'll just make sure that my quarter is all bold. And then I'm just going to highlight the period I'm trying to do. So it's good for you guys to see me make mistakes as well, only because there's a lot of information here and sometimes we do make mistakes, and as long as you catch them, that's why it's really good to have someone else double check your work, then you can fix it and then just move on. Okay, so that is the inventory purchase budget.